How did the shadow banking system trigger the Great Recession? Imagine a financial world where banks are not the only players, and some operate outside the usual rules. That's what the shadow banking system was doing before the Great Recession. These non-bank financial institutions performed many bank-like functions, such as lending money and creating credit, but without the same rules and protections. They grew rapidly, even bigger than traditional banks, offering cheaper loans and more credit options. They funded their loans through complex financial products like mortgage-backed securities and derivatives, which were often based on risky subprime mortgages. These risky loans were bundled together and sold to investors worldwide, spreading the danger for beyond the original lenders. A big problem was that shadow banks relied heavily on short-term funding sources like overnight repurchase agreements and commercial paper to finance long-term assets. This created a mismatch because they used short-term money to fund long-term investments. If investors suddenly lost confidence and pulled their funding, these institutions faced a liquidity crisis. It was similar to a bank-run but happening in less obvious markets. When doubts about the quality of mortgage-backed securities grew, investors quickly withdrew their money. This caused a rapid freeze in funding, leading to a liquidity crunch. Major investment banks like Bear Stearns and Lehman Brothers faced severe funding shortages. Bear Stearns' cash reserves dropped sharply within days, forcing an emergency sale. Lehman Brothers could not find a buyer and filed for bankruptcy. Their failures sent shockwaves through the financial system, freezing credit markets and causing panic. Because shadow banks were not regulated like traditional banks and lacked safety nets, their collapse threatened the entire financial system. The interconnectedness of shadow banks with traditional banks and global markets meant risk spread quickly. This led to a credit crunch, where lending to households and businesses dried up. Governments and central banks stepped in with emergency measures, creating liquidity facilities to support these shadow banking activities and stabilize credit markets. These actions showed how important shadow banks had become in providing credit but also highlighted the dangers of unchecked growth. From a financial history view, the rapid expansion of shadow banking and its reliance on short-term funding created a fragile environment. When it collapsed, it revealed how financial innovation without proper oversight could amplify risks. This chain of events played a major role in triggering the Great Recession, showing the need for better regulation to prevent similar crises in the future.